All right, let's get straight to it. The market is at a critical inflection point. We're sitting at all-time highs, but this week we're staring down a wall of catalysts that could trigger a massive move, one way or the other.
Look, this tug of war between the bulls and the bears, it's about to end. One side is going to break this week. The sideways chop is over.
So, that's the billion-dollar question, right? Are we just consolidating here for a major breakout, or is this a classic blow-off top right before a nasty correction? The data we get this week is gonna give us the answer.
Okay, let's zero in on the catalysts that actually matter. These are the specific triggers for both the bull and the bear scenarios that are on the table.
Just take a look at the density on this calendar. It's absolutely packed. You've got huge micro events with big tech earnings, a massive macro event with the Fed, and a geopolitical wildcard with the US-China summit, all crammed into just a few days. This is an incredibly rare and potentially very volatile setup.
Let's start with the bear case. The risks here are pretty clear, and they begin with a valuation metric that is just flashing bright red.
221%. That's the Buffett indicator, total market cap to GDP. To put that in perspective, we are now officially above the peak of the dot-com bubble. That's a huge pillar of the bear thesis. Historically, you just don't see good returns from these kinds of levels.
So the bear case has a few different fronts. First, straight-up valuation risk. DCF models show that key tech stocks are trading at some serious premiums. Second, this is the big AI show-me-the-money moment. All that capital spend on AI, it's time for it to show up as actual profit growth. Third, that Fed rate cut, it's almost completely priced in, which creates a classic setup for a sell-the-news reaction. Fourth, from a market structure perspective, the S&P is walking right into a heavy dealer resistance zone that could act as a ceiling. And finally, you have the US-China summit, which is a real wild card with a negatively skewed risk profile.
All right, but what about the bull case? Despite all those risks, there are still some really powerful arguments supporting a move higher.
14%. If you're a bull, this is the number that matters most. This is FactSet's forecast for S&P 500 earnings growth in 2025. At the end of the day, profits are what drive stock prices, period.
The bull thesis really stands on this foundation. Profits are growing, the Fed is about to cut rates, and hey, this rally is broadening out beyond just tech. The rest of the S&P is actually showing some real strength. That could open up some interesting contrarian plays in sectors like healthcare and energy. And with the 10-year yield holding stable, the math for holding stocks still works.
This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
So we've seen both sides of the coin. Now, let's translate this into a structured plan so we can navigate whatever volatility comes our way.
Here's the game plan, broken down by scenario. Our base case is for choppy, range-bound action, with the SPY ETF holding between 683 support and 690 resistance. The bull case gets triggered by a combo of strong tech earnings and a dovish Fed, and it's confirmed by a clean break and hold above 690. The bear case is the opposite. Weak tech guidance, a hawkish Fed, confirmed by a break and hold below 683. Know your levels.
So to put it simply, the conflict is this. Bulls are betting that strong profits and a friendly Fed are enough to push us higher. Bears believe the extreme valuations and a potential AI letdown are going to trigger a correction. One of these theses is going to be proven right this week.
All right, let's talk about a few risk-defined setups for these scenarios. Now remember, these are educational examples of how you might position, not recommendations.
First up is a hedge. With this many binary events on the calendar, having some sort of plan to manage downside risk is absolutely crucial.
For that bearish thesis, a bear put spread on SPI is a defined risk way to play it. You're buying a put and selling another at a lower strike, which caps both your potential profit and, more importantly, your loss. The whole point is to position for a sell-the-news event or an earnings miss. The thesis is invalidated if the market breaks and holds above that key 690 resistance level. Sizing-wise, think of this as a starter hedge.
Now, the second setup is for the bull case. Specifically, it's designed to capitalize on the idea that market leadership might be rotating beyond just big tech.
If you're looking to play that broadening rally, you might consider a bull call spread on a lagging ETF like XLV for healthcare. This is a play on potential sector rotation into an undervalued area that has strong fundamentals. Your risk is defined, and the thesis is invalid if the sector just fails to show any relative strength and underperforms the market. Again, start small and only add on confirmation of a breakout.
And for our final setup, we're looking at a high-risk, high-reward idea based on a very specific catalyst narrative. This is purely speculative and demands strict risk management.
Some sources are pointing to a potential short squeeze in quantum stocks like IonQ, possibly catalyzed by a rumored government investment. This is a binary event-driven trade. You could use a call-debit spread to define your risk on this kind of speculation, but the sizing has to be very small because your risk is 100% of the premium you paid if that catalyst never happens.
Not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.
Remember, the market gives you probabilities, not promises. Define your scenarios, know your invalidation levels, and trade your plan.